Hello and welcome to The Bottom Line here on TVP World, where we unpack some of the main business and economic stories of the day. I'm your host, Marie Cato. The EU-US tariff agreement announced over the weekend has evoked mixed reactions. Could this be the closure everyone has been looking for, or is it just the beginning? For now, the EU will pay 15% baseline tariffs. Portrayed as the biggest deal ever made, one can't help but ask a few questions. Konrad Gorlinski brings us the details.
U.S. President Donald Trump and European Commission President Ursula von der Leyen have just made the biggest deal of their careers.
So we have good news. We've reached a deal. It's a good deal for everybody, I believe. And I think you were saying this is probably the biggest deal ever reached in any capacity, trade or beyond trade.
So what's in this new deal?
We have stabilized on a single 15% tariff rate for the vast majority of EU exports.
The 15% will apply across the board and include cars, pharmaceuticals, and semiconductors. The 50% already in place on steel and aluminum will remain, but could fall later. However, there are many exemptions, including aircraft and aircraft parts, certain chemicals, some generic drugs, semiconductor equipment, some agricultural products, natural resources, and critical raw materials. Alcohol is still being worked out. Reactions from the markets were very subdued. Major European indices like the German DAX and the French CAC 40 gained around 1% in the early hours, but later fell amid fears about economic growth. Economists are still gauging the impact, with Beringer Bank and Capital Economics saying the tariffs will shave off 0.3 percentage points of Europe's economic growth this year and in 2026. Others are stressing that the impact has to be considered in the long term.
So from this broad economic point of view, we need to remember that short-term impact of tariffs is, of course, negative, but then in the long run, it is possible and it is very likely that they create additional boost to European growth, and in particular to Polish growth as well.
In Poland, the main WIG index dropped just 1%, a less volatile day than usual. Poland has little exposure to the American market, but some of its industries will suffer, like automotive and furniture, which supply German and Scandinavian firms with exposure to American markets. The deal is not limited to just tariffs. Europe has agreed to additional points to placate Trump's belief that the old continent is treating the U.S. badly. Under the agreement, Europe will replace Russian gas with $750 billion in energy purchases from the U.S. The deal also includes $600 billion in new direct investment into the United States, along with billions more in additional U.S. military equipment purchases as Europe ramps up rearmament efforts.
But I think it's very unlikely that this is going to hold for the length of the Trump presidency. He likes using the leverage of tariffs too much, and there will be, I'm sure, some perceived injustice that he will find about the way that Europe behaves that will bring further negotiations onto the table. I think it's unlikely that this will hold all the way through.
So only time will tell whether this deal brings much-needed stability to transatlantic trade.
We've reached a deal.
Trump is perceived as the immediate winner, with Ursula von der Leyen and the EU failing to take advantage of its negotiation capacity. But is it really about winners and losers, or was it about avoiding a trade war? To discuss what lies ahead, we're joined by Maciej Stefański, senior economist at EY. Hello, and thank you very much for joining us.
Good afternoon.
So let's start with market reactions. The main European indices gained early morning in the early morning hours, but then lost the gains. The euro weakened against the dollar. So is there less optimism than at first?
I think the deal is largely in line with expectations, so we shouldn't have been expecting a big changes in the stock market in the first place. So there have been some moves as usual. The market is trying to feed through the news, but in general, I would say this is in line with expectations, so it was already included in the stock prices.
Okay, so no massive surprises. Now let's move on to impacts. The details of the US-EU trade deal are still emerging. We don't know everything as of yet, but we know that 70% of Europe's products are expected to be subject to 15% tariffs from this coming Friday. we know that the EU is maintaining 0% import levies on some American imports. Capital Economics says that the deal will shave off 0.3 to 0.5 percentage points from European GDP. What kind of impact can we expect to see?
We expect a similar impact, I would say. So in terms of the EU, I think around 0.5 percentage points next year in terms of growth. But of course, various countries will be affected to a varying degree. Ireland is the one that is most affected because it is heavily dependent on exports of the US, in particular of pharmaceutical products that have been imposed with 15% tariffs in this deal. So that's one. On the other hand, we would see countries such as, I don't know, for example, Greece, which are service dependent. They do not really produce that much manufactured goods, or least so export them to the US, and then the impact will be minimal.
Germany heaves a sigh of relief on behalf of its automotive industry. 15% means that the levy on cars is almost half. Many German automakers complain that tariffs have hit their bottom lines. Porsche is an example of that. But on the other hand, we have Wolfgang Niedermark from the Federation of German Industries, who said that even a tariff rate of 15% would have a hugely negative impact on Germany's export-oriented industry. What are you expecting to see?
Yeah, Germany is one of the most impacted countries because it is heavily industry, depends on industry and exports to the US in particular. So indeed, I would say around 0.7% percentage points of GDP growth will be shed next year because of these tariffs relative to this no tariff scenario, so before the election, if you like. In general, manufacturing is subject to tariffs. One thing that we should perhaps say to the viewers is that these tariffs are only about manufactured goods and not about services. And there is actually quite a big export of services to the US, so these are not subject to tariffs. So in general, manufacturing will be more heavily affected. Then services, though, some second round effects from lower demand in the overall economy will also hit the service sector.
Now, I want to focus a little bit on Central and Eastern Europe. Obviously, Germany brings us to this. What can we see in terms of these tariffs impacting Central and Eastern Europe? And obviously, each of these countries in our region is in a slightly different situation. Perhaps we can start with Poland to begin with.
So Poland is affected, I would say, a little bit below the EU average because of a relatively small direct export to the US, and at the same time, let's say, moderate trade openness. So we expect growth to be lower by 0.3, 0.4 percentage points next year as a result of these tariffs. On the other hand, countries such as Czechia or Hungary are among the most affected countries in the EU because of their heavy dependence on industry and in particular on automotive industry, even though we have this decline in tariffs on automotive. So this does provide some reprieve for these countries.
Are there any other industries, because we keep talking about the automotive industry, but are there any other industries that might be affected, or perhaps industries that might not be affected so much perhaps in the region?
I think in general, we should distinguish between the short-term impact and the long-term impact. So in the short term, as I mentioned, I think the whole economy will be negatively affected, but to a varying degree. And then machinery industry, in general, these industries that have relatively high share of exports to the US, also steel and aluminum industry, which still is subject to higher 50% tariffs, at least partially. So these are some of the most affected. Least affected in general, the service sectors are less affected. But in the long term, what matters more is not the absolute level of tariffs, but the relative level of tariffs across countries. So EU is actually subject to tariffs which are similar to other countries, for example, the same level as Japan, but lower than China. So it means that the EU is unlikely to lose much in the long term from these tariffs. Still, some sectors may lose out because Chinese producers will divert their exports from the US to the European market. And for example, we expect the clothing industry to be one of the most affected because of this, for this reason.
Are there any sort of backup strategies that perhaps our region might have to protect itself from the impact of these tariffs, regardless of what is happening in the EU, because the EU obviously has its own plate full of problems?
It's, trying to diversify exports, probably into Asia, for example, that could be a strategy. In general, the thing is that we maybe do not export that much directly to the US, but there is this indirect exports via Germany. So trying maybe to escape and diversify from this key export market is would probably the most effective strategy, because one of the ways, obviously, that companies may try to avoid tariffs is to relocate into countries which are subject to no tariffs, so the US or Canada, Mexico, or other countries which are subject to 10% tariffs. But given that we have 15% tariff in the EU, then the benefits may not outweigh the costs for this kind of relocation. So I wouldn't expect to see a massive relocation of production away from the EU to the US or other markets.
Sure. We also have the EU's commitment to invest $600 billion in defense and, in investments, and $750 billion worth of purchases in energy. What does that actually mean in terms of what will happen to European markets, to the economy, for European industries? And just before you answer my question, we've seen Politico report that the EU has already hinted that it won't actually be able to deliver on its promise of investing $600 billion worth of investments, that it will have to turn to private investors. So it's made this commitment, but it's already pulling out, saying this is too hard to deliver on. So what does this tell us?
Yeah, so I think that the easiest promise to hold is the defense spending, because NATO countries have already agreed to increase defense spending, and we know that this has to be primarily from imports in the first place, because the European defense industry doesn't have spare capacity to meet all this demand. So I think this part is relatively easy to do. The rest, energy imports, a lot of this substitution has already happened following the war in Ukraine, obviously, so increased imports of gas from the US. There is some scope to increase this further, for sure. Can we do as much as we promised to? We'll see. To be honest, I haven't analyzed this in much detail. In terms of investment, again, probably the devil will be in the details, how this is defined, what's the benchmark or the baseline against which we have to increase this investment by 600 billion, and how this is counted. Obviously, this will be mostly private sector. Governments won't be investing directly in the US. So it's just a question maybe of providing some sort of incentives to the private sector to actually invest in the US, which is obviously a bit counterproductive for the European economies.
We see a lot of criticism about this deal. Do you think that the EU could have managed these negotiations better? Because all this time in the run-up to this announcement, the EU said that it had all sorts of tricks up its sleeve. Were we naive as recipients of all this news that the EU could have played hardball?
I think that there were two strategies. One was used by China, which was reciprocal tariffs straight away, very quickly. And it was effective in a way because, okay, the tariffs on China are higher than on the EU, but the threats were much, much higher. So you might say that it was a more effective strategy, perhaps. Here in Europe, we tried to play it safe. We ended up with 15% tariffs. Still could have been worse. It's difficult really to say, to be honest. I think at the end of the day, probably both strategies would result in similar outcomes.
We see that markets have responded positively. Some say that the reactions have been subdued. At the moment, we don't see any sort of massive disaster. Do you think that this is because we see that this is the end of some period of uncertainty? There's the prospect of some level of stability and no prospect of an immediate trade war?
Yeah, exactly. So certainly the upside of this deal is that it reduces uncertainty. Obviously, we are still waiting for some details. Not everything is yet decided fully, but it does decrease uncertainty, especially related to these sectors which were supposed to be subject to a sectoral tariffs, which were supposed to be announced in the coming months. And I mean the pharmaceutical industry and semiconductors. These are the two key industries that weren't subject to any tariffs so far, but we knew that something was coming and we didn't know what, and there was a threat of 200% tariffs on pharma. So having only 15% is a good result in this context.
As you say, it could have been worse. We could have been slapped with 50% tariffs, 30% tariffs. 0% for the US obviously is a win. And obviously the EU is going to spin this story that it could have been worse. But the devil is in the detail. Not a lot is, we don't have the details set in stone just yet. But what do you think might emerge in the days to come?
I think the deal is more or less there in terms of the details. So we can assess the macroeconomic impact. There will be some, additional negotiations. Obviously, some CEOs from big industries will be going over to the White House, to the European Commission, trying to still gain something. But I think we are there to stay with more or less these tariffs throughout the Trump term. If that's what I would say. So far, Trump has been surprising us to the upside in terms of the tariffs. So the tariffs have been higher than we expected. When he won the election. So I wouldn't really expect much of a decrease. And what will happen after the Trump term ends? Now it's extremely difficult to say. I wouldn't be too optimistic that even if the Democratic president is the next one, we will see a radical decline in tariffs.
Do you think that the EU is now on the back foot? Because the EU-China summit obviously didn't go very well. There were no massive successes on that front. The situation with Russia isn't delivering any successes for the time being, and that the EU realizes that essentially it needs a better relationship with the US. So it's essentially trying to appease Donald Trump, assuming that if Trump is happy, in inverted commas, whatever that means, that the EU can depend on him when necessary, when push comes to shove.
Yeah, I mean, it's a geopolitical question, I would say. So obviously, I think Europe has to play a bit, both hands in a sense, the US and Chinese one. I would say, economically, we are not in a very bad place in Europe, despite all the doom and gloom that we had, the past year or so. Economic growth has been relatively steady. No major effects of tariffs are evident so far in the economy. So I don't think that the situation is as bad as some people think.
So you think the EU is doing well?
The EU is doing decently, or well, let's say. I wouldn't say this is like a great performance, obviously, but given the circumstances, the conditions that the European economy is operating in, demographic pressures, that's one of the big differences between the European and the US economy, that we have much slower population growth, and this simply translates into lower GDP growth.
Okay, well, on that positive note, Maciej Stefański, Senior Economist at EY, thank you very much for joining us.
Thank you.
And that concludes The Bottom Line. For today, I was your host, Marie Cato. We bring you the best of regional business Monday to Friday at 5:10 CET on TVP World. And in the meantime, for the latest in regional business, follow us on X and on tvpworld.com. Goodbye.